Singapore's Kopi Money Showdown, DBS versus OCBC versus UOB versus REITs. As interest rates fall, one big question is brewing. Will the Kopi Money crown move from our banks to the REITs? DBS, OCBC, and UOB just posted strong third quarter 2025 profits. But can those juicy 5 to 7% dividends keep flowing as the Fed keeps cutting? Or will the REITs finally stage their comeback and steal the income spotlight? Stay till the end, because I'll show you how to build the ultimate Singapore dividend portfolio and reveal which bank truly gives you the sweetest Kopi flow in 2025. If you find this useful, like this video so more Singaporeans can learn, and subscribe to Wealth for You for weekly Kopi Money insights. Disclaimer: all information is obtained from official SGX filings and public sources. This content is for education and general information only, not financial advice. Always do your own due diligence before making any investment decisions. Chapter 1. The banks still holding the fort. Let's start with our three hometown heroes, DBS, OCBC, and UOB, the banks that keep Singapore's Kopi money flowing. DBS delivered another strong quarter, earning 2.95 billion Singapore dollars, up 5% quarter-on-quarter. Its NIM eased to 1.96%, but profits stayed firm thanks to strong wealth management income. Dividends remain juicy, $2.85 per share annualized, or about 5.3% trailing yield based on 10th November 2025's closing price of $54.27. OCBC brewed steady results, posting 1.98 billion Singapore dollars in net profit, flat year-on-year but higher quarter-on-quarter on improved fees and trading gains. Its NIM slipped to 1.84%, yet it remains one of the most conservatively managed banks in the region. Dividends stayed generous, 98 cents per share year-to-date, translating to a 5.4% trailing yield based on 10th November 2025's closing price of $18.19. UOB had a bitter quarter. Profit plunged 72% to 443 million Singapore dollars after taking a 1.1 billion preemptive allowance. Still, capital remains strong, and dividends of $2.27 per share give a 6.7% trailing yield based on 10th November 2025's closing price of $33.68. Of course, remember, yields move when prices move. Dividends stay fixed, but share prices, just like Kopi prices, go up and down. Across the board, our banks remain resilient but cooling. NIMs around 1.8 to 2%, CET1 ratios above 14%, and dividend yields in the 5 to 6.7% range. The Kopi froth may thin, but the pot stays hot for patient income investors. Chapter 2. When rates fall, banks cool down. After 2 sizzling years, the Kopi pot is finally cooling. The U.S. Fed cut rates twice in September and October 2025, a total of 50 basis points, and the impact reached our banks almost instantly. Margins are tightening. DBS expects about a 4 basis point dip in NIM. OCBC sees NIM settling around 1.8%. UOB likely stays below 1.8% into 2026. Still, it's not all bad news. Lower rates spark loan demand, revive wealth income, and ease funding pressure. A welcome boost for DBS and OCBC's fee-driven businesses. UOB too benefits from cheaper regional funding across ASEAN. Dividends should remain steady and sustainable, backed by CET1 ratios above 14% and decades of conservative discipline. So yes, the foam's thinner, but the Kopi still flows, just a little less cow, yet still warm enough to enjoy every sip. Chapter 3. REITs are making a comeback. After the two Fed rate cuts in September and October 2025, a total of 50 basis points, the REIT market finally started to wake up. Lower rates mean cheaper borrowing and higher distributable income, giving S-REIT investors the relief they've been waiting for. CICT kept gearing below 40%, with debt cost around 3.3% and yield near 4.7%. Modest, but steady and improving. Mapletree Industrial Trust, or MIT, stayed resilient, with over 94% occupancy and roughly 6.3% yield, powered by strong data center demand. REIT ETFs like Lion-Phillip S-REIT ETF, ticker CLR, and Amova-StraitsTrading ETF, ticker CFA, offer 5.5 to 6% yields, giving easy, diversified exposure without stock picking. In short, as rates fall, REITs stabilize, yields firm up, and sentiment turns positive. While banks cool, REITs are warming up, a COPY seesaw that keeps the income flowing from both sides. After 2 tough years, the REIT engine is humming again. Not frothy yet, but brewing steady COPY money for patient investors. Chapter 4. The Ultimate Singapore Dividend Mix for 2025. If you want your COPY money to keep flowing, rain or shine, here's a simple, timeless blend to remember with your morning brew. So, here's how I'd break it down. 40% in banks. That's DBS, OCBC, and UOB. These are your rock-solid foundation for stability. These hometown heroes deliver dependable dividends, strong balance sheets, and the unwavering confidence of Singapore's financial backbone. Another 40% goes to REITs, or REIT ETFs, like CICT, MIT, CFA, and CLR. This is your growth and recovery engine. As interest rates fall, REITs enjoy cheaper financing, firmer valuations, and rising income potential. The perfect companion to balance your portfolio's COPY blend. And, of course, the last 20% should be in cash or Singapore savings bonds. This is your safety buffer. It gives you flexibility to seize opportunities when markets dip, and peace of mind when volatility brews. Put all that together, and this mix can deliver a steady 5.5 to 6% yield, blending stability, growth, and resilience. Just like your favorite COPY, strong, smooth, and satisfying through every market cycle. Chapter 5. Risks to keep an eye on. Even the best COPY can turn bitter if you're not watching the brew. For banks, falling net interest margins will squeeze profits as rates drift lower. There's also exposure to China's slower economy, especially the property sector, which adds volatility. Just ask UOB after its 1.1 billion Singapore dollar allowance. Our banks remain strong, but even a steady COPY loses heat when global winds cool. For REITs, lower rates do help, yet refinancing old, high-cost debt keeps finance expenses elevated. Singapore's prime CBD offices are holding up, but older buildings and Hong Kong assets still face pressure. It's important to stick with strong sponsors and sensible gearing. Those with deep pockets weather storms best. And for everyone, don't chase yield blindly. COPY too sweet may taste good today, but leave you jittery tomorrow. Focus on sustainability. Dividends you can count on, not just crave. Chapter 6. What 2026 could bring. As we sip into 2026, the COPY mix is shifting, slowly, but mostly for the better. With the Fed's 2 rate cuts in 2025 already easing pressure, analysts expect 1 or 2 more gentle moves in 2026. That means lower borrowing costs for REITs and a chance for distribution per units to stabilize or inch up, while banks adjust to a new normal. For banks, net interest margins may narrow further, but loan growth and wealth fees should offset some of the dip. For REITs, refinancing gets easier and valuations firm up. The key word for 2026 is balance. Banks providing stability, REITs offering recovery, and disciplined investors quietly collecting Kopi money each quarter. It may not be a year of fireworks, but it's shaping into a year of steady returns. And that's exactly how income investors build real wealth in Singapore. Final thoughts. Be cash flow rich, not paper rich. At the end of the day, whether your Kopi comes from banks or REITs, the goal stays the same. Steady, sustainable cash flow that lets you live life on your terms. Banks give you stability. REITs add growth, and together they form your long-term income engine. But the secret ingredient is discipline. Keep investing. Stay diversified, and let time do the compounding. Keep investing through cycles. Focus on quality over hype. Let your Kopi money grow while you sleep. Wealth isn't about flashing numbers on a screen. It's about freedom. When your dividends cover your Kopi, your meals, even your travels, that's when you know you're truly cash flow rich. If you enjoyed this, give it a thumbs up so more Singaporeans can learn. Subscribe to Wealth for You for your weekly dose of Kopi money insights. Till next time, stay steady, stay invested, and keep your Kopi hot.